a platform that hopefully will be a consensus.
How the economy evolves, how the labor market moves, how wages moderate, impact of tightening on the financing of the economy. And that all these factors will be taken into account to determine future moves. On your second question, it's a matter which is under discussion at the European Commission level. It's a matter which is highly debated within the G7, which is a complicated issue which has legal ramification. And while there is no doubt in anybody's mind, I think, that Ukraine will need significant financing for its completely legitimate reparation program as a result of this aggressive and unjustified war by Russia against Ukraine. The financing, the sources of financing, the terms under which it is deployed by those who will support Ukraine need to be agreed and need to respect the international legal environment in which we operate and be particularly attentive to the international monetary order and the rule of law which has been enforced for decades. There are interesting propositions that are being reviewed concerning the interests generated by the proceeds, such interests belonging actually to Euroclear, which could possibly prosper, but that's clearly work in progress on which we have no final say. It will be for the leaders to decide what happens.
Thank you. Turning now to the online participants, I'd like to give the floor to Fabrizio Goria of La Stampa. Fabrizio, please.
Thank you, Wolfgang, and thank you, President Lagarde, for taking my question. There are two questions, actually. So the first one is, do you see any possibility that the Federal Reserve decisions could affect the ECB moves? And the second one is about the commercial real estate market. Do you see any vulnerabilities in the European CRA market, considering the stress that we're seeing in the United States? Thank you.
Thank you very much for your question. On the mandate that we have, the mission that we have, the ECB acts independently, and we will do what we have to do when we have to do it. Obviously, we are mindful of the international environment in which we operate, but if the conditions are satisfied, if our diagnosis is that we have been restrictive for long enough to be sufficiently confident that we will reach our 2% targets, we will make our decision. I know there is writings here and there and views about the order and the sequence and reference to previous episodes, but I really think that we have to act in accordance with our mandate. The second question, if I may, dear Vice President, I will pass it on to you. Not that I don't want to answer, but you're far more qualified than me.
Well, good afternoon. Commercial real estate, as you know perfectly, is something that we have reiterated as one of the main risks for financial stability in the euro area. We have seen an important reduction in the volumes of transactions and the transactions in commercial real estate, even before starting the tightening of monetary policy. And we have seen as well, a decline in prices. But what I can say with respect to commercial real estate that I think that is relevant is first that the exposure of the European banks to commercial real estate is quite limited. If you look at the figures, commercial real estate credit amounts something close to 5% of the total assets of the European banks. But the problem is not the average. And the problem, and this happens quite often in economics, is the disparity around the average. And here, there are some, some banks that have, a higher exposure and a higher concentration in their portfolios, in their balance sheets to commercial property, to commercial real estate. And this is something that, well, we have been monitoring very closely. We have not seen so far any sort of, let's say, widespread contagion because of the evolution of commercial real estate. We have indicated several times that the exposure of the non-banks is much bigger, is larger than the exposure of the banks. So I repeat again, this is something that we have been looking at very carefully, and is one of the main risks for financial stability at present.
Thank you very much, Vice President and President. The next question goes to Santi Pinol of Market News International. Santi, please.
Thanks. Good afternoon, President Lagarde.
Good afternoon.
My question is, what would be the ECB approach if we see that inflation remains sticky around this 2.5 area in the following months? It would be like any changes? In other words, how much growth are you willing to sacrifice for a small deviation? Another question, it's unit costs are partly being absorbed by profits. Is that your view that this will continue in the future? And do you think it will be enough to offset the inflationary impact of wages increases? Thank you.
Well, thank you for your two questions. It's not a question of sacrificing growth. And I would just remind you that in our projection, while aiming at reaching our target timely and in a sustainable manner, as our projection indicate, we also project recovery during the second half of 2023 and more importantly in 24 and more importantly in 25 and 26. Our projection is 1.5% in 25 and 1.6% in 26. So what we are really seeing is a slight delay of a process that we had anticipated. And we stick to our projection. Maybe you will have observed that recently our errors in our projections have reduced significantly, and they certainly make us feel more confident, not sufficiently confident yet, but more confident that we will reach the target. Your second question was about the unit labor cost. And you suggested that unit profit cost would absorb, or was absorbing, I don't know exactly how you put it, but you assumed that it was absorbing all the labor cost. This is not quite the case yet, and we have seen some encouraging numbers in the late part of 23 and earlier part of 24. This is really one of the hypotheses that we made for our projection, and our projections are predicated on that precisely. We want to see that movement confirmed, both moderation of wages as we anticipate, but also the reduction or the squeezing, if you will, of profit margins, so that the unit profit cost absorbs part of the unit labor cost. Thank you.
Thank you, Madame Lagarde. And the next question goes to Andres Stumpf of Expansión. Andres, please.
Thank you. I have two questions, if I may. Even if the decision was unanimous, did anyone at the Governing Council suggested that cutting rates today? And the second question, is there a huge difference between cutting rates in April or doing so in June? I mean in both in terms of economic pain, but also on the amount of that data you will have for that decision. Is there really a difference? Thank you.
Well, thank you. Those are really two good questions. So first of all, we have not discussed rate cuts for this meeting. Not, full stop. What we have done is that we have just begun discussing the dialing back of our restrictive stance. But of course, we need a lot more information coming in the next few months to be sufficiently confident. And your second question related to the degree of information. Well, when you look at what will be published, what data we will have, both in terms of activity, in terms of wages, in terms of profit, we will have a little in April, a little. And we will have a lot more for our June meeting.
Thank you.
And it matters because we are data dependent and we are adamant that we will be data dependent.
Turning back to online participants, I'd like to give the floor to Tom Fairless of the Wall Street Journal. Tom, please.
Good afternoon, President Lagarde.
Good afternoon. No, good morning.
Good morning. I had two questions on the sort of a US angle. Firstly, investors are betting that the Fed and ECB will both start cutting around June and at a similar pace. And given the different economic landscape on both sides of the Atlantic, do you think that's reasonable that they should be expecting that with inflation and growth lower in the Eurozone? And secondly, the language that you've used today is similar to what we heard from Fed Chair Jay Powell yesterday in terms of there being no rush to cut rates. And notwithstanding what you said about your ability to act independently, does it broadly make sense for major central banks to lower interest rates at the same time? Thank you.
Well, thank you so much for your question. But in a way, I think I addressed it earlier on when I explained that the ECB is an independent central bank and will act independently. So we will decide on the basis of the three criteria that I have mentioned earlier, on the basis of the measurements that we have, the projections that we have, the additional data that we need. We will determine what action we need to take. And that will be done independently from what my colleague from the Fed decides to do. As to whether or not investors are reasonable or not for me to say. What I hope we can do ourselves is be attentive, monitor carefully. Once the data confirm that we are sufficiently confident to reach our 2% target in the medium term and make sure that it will be sustainable, we will act. That's really what I can tell you. By the way, I didn't say that there was no rush, remember? I said that we did not discuss cuts for this meeting, but we are just beginning to discuss the dialing back of our restrictive stance, provided that we have enough and certainly more information to be sufficiently confident.
Thank you, Madame Lagarde. And another question for online participants from Eric Albert of Le Monde. Eric, please.
Thank you very much for taking my question. I just wanted to come back to what you mentioned at the beginning, the loss of competitiveness of Europe. How permanent do you think it is? How worried should Europe be about that? And then coming back on wages, can you explain a little bit on your thought about it? I mean, you said you don't have enough data for now, but I mean, what kind of data do you need to see to be confident enough? What kind of level do you want to see? And isn't some kind of catch-up of purchasing power needed actually for the European economy?
So thank you very much for your two questions. On the first one, I think that we will learn a lot more on competitiveness and how dramatic or not dramatic it is when we read the report by President Draghi. But you can observe that Europe has lost competitiveness in a durable manner for the last couple of decades, and that was accentuated certainly during the financial crisis. So it's one of the reasons why the Governing Council was of unanimous and very strong support for capital market union to be rolled out, obstacles to be removed, supervision to be strengthened, and capital to be kept and made to work at home in Europe rather than elsewhere. It's not the reason, the response, but it's certainly one of the response which matters to us because it is also conducive to transmission of monetary policy in a slightly different way. Your second question, look, when we look at the underlying inflation and the measurement of underlying inflation, there is one obvious outlier in the measurements, and that is domestic inflation, and that is services. So you have to get under the skin of that and determine what is behind it and what drives it up. Clearly, it is wages. And because of this determination to avoid what I've called the tit for tat on previous occasions, we are also very attentive to profits. So it's a combination of the two. I'm not suggesting that wages should decline or that wage growth should be dampened. This is not what I'm saying. I'm saying that it's a major component of services and domestic inflations. Services is moving just a tiny bit. It was at 4% for the last 3 months. It's moved to 3.9%. Domestic inflation is slightly up. So we have to be specifically attentive to wages. And as many of you know, and as I'm sure you know, a lot of the indicators that we have, a lot of the data that we receive are a bit outdated. We will get the Q4 number tomorrow, which is more than 2 months after the end of the quarter. So we have to look at other indicators as well. We have our wage tracker, which sticks to all the agreements that are negotiated and signed. There is about a third of the employees that are covered by that wage tracker, of which the contract will stop being covered by an agreement as of now or at the latest in March. So we need to have that as well. We look at Indeed, as everybody does as well. And all these elements are showing us that there is an element of moderation. So growth is moderating. It's not going up as much as it did in late 22 and in the course of 23. It's the growth of it is moderating. So that's what we will be looking at very, very carefully. The fourth element that we also pay attention to is the corporate telephone survey, or the SMA as well, to hear from the corporate employers what is the labor shortage, how much hoarding do they have, to try to anticipate in a still tight labor market where wages are going to go.
Thank you, Madame Lagarde. And the next question goes to Minami Takeru of Nikkei. Minami, please.
Good afternoon, President Lagarde, and thank you so much for taking my question. So let me ask one question for better understanding. This is about wage growth and inflation. I think that even if wages continue to increase, the declining trend in underlying inflation may continue. It's just a possibility, but in this case, which one do you consider more important to decide to cut interest rates? The declining inflation trend or wage growth rate? Thank you so much.
Thank you so much for your question, but we will be looking at all of that because we continue to look at the three key components: the inflation outlook, and that tells us what we should expect on the basis of the projections that are prepared by staff. And that indicates clearly that we are in this disinflationary process, that inflation is declining. But we also look at the underlying inflation and what feeds some of these underlying inflation, including in particular wages. So we also look at that because we want to be stable on three accounts: inflation outlook, underlying inflation, strength of transmission. On the latter, I think strength of transmission, we're seeing a good and solid transmission to the financing sector, and then further down the road to the economy. Thank you.
Thank you. And the last question goes to Jean-Philippe Lacour of AFP, Agence France-Presse. Jean-Philippe, please. You have to unmute. We do not hear you.
We do not see you either.
We do not hear you, Jean-Philippe. I'm very sorry. I can see you, but nobody hears you.
You can seem not happy with this computer. That's obviously the case.
Okay, well, it will be next time, Jean-Philippe. So we come to the end of our press conference. Thank you very much for following. The next press conference will be on the 11th of April. Until then, all the best. Thank you.
I mean, you could build a
NVIDIA camp who are selling stock. They've been on the board since 1983. NVIDIA is bid, stocks are strong. Let me just show you the reflection of what came from the ECB. This is where, in the very first instance, traders began to reprice 100 basis points of cuts this year. The growth outlook for this year was cut by the ECB. They talked about inflation coming to 2% in 2025, a dovish hue. Christine Lagarde came out and subtly but deftly unwound those bets. She talked about a gradual pace. She talked about a situation of where we don't have enough data. We won't have enough data in terms of movement. We will move before the core hits 2%. She needs more data to be more confident on moving. That sounds more like June. And in terms of a commitment to the pace, and this is something we must all get a hold of globally. There's a holding season that moves to restrictive, then you move to normalization. She will not commit to a pace, a rhythm, or a magnitude of cuts. And that is a global caveat we all need to grasp, from the Fed to the ECB to the Bank of Japan. Let me show you the immediate ramifications across the bond markets as well. In the very first instance, we saw a more significant drop in yield across the Bund, the Bobble, and the Schatz, 2s, 5s, and 10s. That has been unwound now as she talked about the concern about wages remaining hot. And that is 4.5% on wages, sequential core at 4.3%. The warnings were there in terms of the ability to move. They are not there yet. Christine Lagarde weighed in on the ECB's decision.
There are signs that growth in wages is starting to moderate. In addition, profits are absorbing part of the rising labor costs, which reduces the inflationary effects.
Joining me now to discuss is Invesco's Alessio De Longis and Winnie Sizer from Credit Insights. Winnie, to you first of all, this is a deft president. The market got all doved up on the headlines, and she came out basically, I think, giving the narrative that all central banks want to communicate, which is we're not there yet, we don't have the data yet. And if anything, this was a very clear narrative to the markets that central banks are so fearful of moving early, isn't it?
I think so. And I do think that Lagarde benefits from the hindsight of the December Fed press conference, where Powell came out much more dovish than we had anticipated. The market really took that, ran with it. Financial conditions eased considerably. And central banks have not seen the progress on the data that they want to see to start to really talk about cuts being on the table, even though the market really continues to presume that they are.
Indeed. And in terms of that pro-risk narrative, and this is the point, Alessio. Again, all of these markets are in a pro-risk soft landing mode, aren't they? But the more that we hear from central banks, the more hesitation there is imbued in risk.
Yeah, correct. The first push towards risk was really driven by this expectation that would be meaningful and aggressive cuts. As that view didn't materialize, as you alluded to, didn't materialize really anywhere yet, markets are still showing that resilience because ultimately they found a comfort zone with growth that is stable and improving on a go-forward basis. We saw it also in the projections for the ECB. While inflation, yes, it's not falling as rapidly as hoped, but it is at 2% on a projected basis. Basically, inflation is no longer a risk factor for the market. We talked about that Goldilocks scenario. That continues. No news is good news.
A very quick response from both of you. I want to move the agenda along to the US and to Powell, but very quickly, I had Allianz with me this morning, one of their chief economists, and basically said the biggest risk for the ECB is that the Fed does not move. Tail risk or real risk? Alessio?
The Fed not moving, I would call it still a tail risk. I more second your view from earlier, where I believe this cutting cycle for the major central banks is going to come somewhat synchronized, as you alluded to earlier. And that's also explaining why FX volatility, currency volatility is extremely reduced, with the exception of the Japanese yen. The Bank of Japan is the only central bank that is moving the other way towards rising interest rates. That could be the main story for the second half of the year.
It could indeed, and then we can debate whether that's one and done and what that does. Winnie, before we shift to the Fed, how important is it that the Fed goes before the ECB has the capacity to go? Because it's a danger, according to Allianz.
Yeah, so we have expected that the Fed is going to go first, just given the progress of inflation in the US versus the Eurozone until recently. Now, I think it's a little bit more of an even split. We do expect that the Fed should go as soon as May and the ECB perhaps in June. But I don't know that necessarily we need to see the Fed cut in May in order to see the ECB cut in June.
Okay, at the sequencing, let's see whether it is a concertina as always, or as it historically been. Okay, stay with me, team. We've got a little bit more fresh data out of the US today. Investors are gearing up for the second day of Fed Chair Powell's testimony and the US payrolls report. We're counting down to that. Mike McKee is with me. I don't know whether it's too early for the whisper number. Mike, good morning.
Well, the whisper number for tomorrow is pretty much what we're getting for the consensus number. I'll get to that in just a second. Here's the data from today. If you're looking for something to push the Fed one way or another, you're not getting it, because basically what we are getting is data that doesn't show much change in the state of the U.S. economy. Jobless claims, same as last week. Continuing claims go up just a little bit, but that's because the previous week was revised lower. January trade, the one outlier, a little bit weaker trade deficit, and that does subtract a little bit from first quarter growth. Productivity unchanged in its revision. So market looking at these numbers, I mean, we're pretty much status quo in the economy. So what does Jay Powell say today? Well, on rates, it's going to be the same story, maybe sometime this year, but not yet. Bank regulations were big in the House yesterday. They'll probably be even bigger in the Senate today. Elizabeth Warren, Sherrod Brown, he'll say they're still reviewing it. Yesterday, he said, do expect changes. Balance sheet, he said yesterday, not an issue. QT continues. The one thing that didn't really get asked yesterday, might come up today, is on the U.S. debt. He said on 60 Minutes that it's unsustainable, but he'll take the usual Fed attitude of, you guys fix it, we don't get involved in this. You mentioned the jobs numbers, so let's see where we are now. February payrolls expected to come in at 200,000, the whisper number 203,000. So Wall Street leaning pretty much with the consensus. Private payrolls up 160,000. That compares to the 140,000 private payrolls we got yesterday at ADP. No change in unemployment, and we do expect, or at least economists do, a drop in average hourly earnings on a month-over-month basis that pushes the year-over-year down as well. That would be welcome news to the Fed, which thinks that year over year we should be running about 3 to 3.5% for sustainable inflation. But that's the only kind of outlier in the forecast for tomorrow. Although, man, I have to say, 200,000 seems like a big drop from 353,000, but a couple of months ago, we were talking about 180,000 as a big number. So we're still looking at a very strong labor market.
Yeah, unemployment sub 4% and wages are strong. Mike McKee, thank you very much. My guests this morning are Alessio De Longis and Winnie Caesar on the markets. Alessio, to you first of all. I mean, you know, we start another day. It's been almost, let me just give you the fact. I mean, I was quite shocked by this. The longest streak without a 2% drop. I mean, this market is bolstered by investment liquidity and topped up by retail flow. Yet you have a concern that that there is going to be a moment of where we return to the mean. And you make this point. How soon will this market take a breath?
What we refer to a bit of a return to the mean is particularly to the biggest spread, the biggest anomaly that we have seen from a cyclical perspective, which is this outsized outperformance of quality mega cap tech relative to sectors and styles in the equity market that at this junction with improving growth and stable inflation should have outperformed much better, such as small caps, mid caps, value-oriented sectors. These cyclical sectors have lagged the cyclical move. That's the mean reversion that we are more concerned, actually not concerned, actually positioned for. But in this environment, the overall equity market and risk assets in general, including credit, we believe until something breaks, and it doesn't look imminent, investors, in our opinion, are still compensated to take risk, whether it's credit risk or equity risk. And it's only in the equity market that we would suggest a rotation in favor of cyclicals, expecting some mean reversion in the outperformance of mega cap tech.
So Winnie, it's the perfect world, isn't it? Nothing's breaking. Alessio's chilled. He wants to take risk. We're all bulled up pretty much every day. I don't know how much more bullish we can all become, but is there enough in credit for you? Is there enough return, briefly, in credit for you at the moment?
I would say on an all-in yield and total return basis, absolutely. Yields are still quite elevated, really globally across credit. It's that spread dynamic. How much are you getting paid to actually take credit risk that people are a little bit more wary of? And we've seen an interesting shift this year where triple Cs have been underperforming. Spreads are a bit wider there year to date, which is a reversal from what we saw in 2023.
Okay. Thank you very much, Alessio and Winnie. On the markets coming up, countdown to State of the Union with the details on what to expect right here on Bloomberg. Good morning.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
This is probably the most important speech he's going to give the American people. President Biden right now is historically behind every single president except President Carter on 5 to 6 of the most critical metrics that we've relied on historically to gauge how strong a president's position is going into re-election.
President Biden prepares for a consequential State of the Union address. That's tonight, 9 p.m. Eastern. This comes as Biden faces mounting pressure on an array of political issues, including immigration and the economy, as well as concerns over his age. Anne-Marie Hordern is in the Capitol for us, tracking the State of the Union. Anne-Marie, good to have you with me. We've talked about the significance of this speech. I really want to drill into the content in terms of the key message. Good morning.
Good morning, Manus. Yeah, the significance is not lost on anyone. A lot of people in Washington are calling this, Greg Valliere this morning in his note, Biden's most important speech of his presidency, given the fact that it's not just a report to Congress and the American people about the State of the Union, but the fact of the matter is that what he is going to be pitching if he was to be reelected in the next 4 years. So when you get into some of the substance, what matters to the markets, you know, we talked to Tobin Marcus earlier, and he talked about the fact that talk isn't just cheap. A lot of the stuff has to do with policy. When you look at tax policy, that's going to be something that's key to this election because the Trump-era tax cuts expire at the end of 2025. And both former President Donald Trump and current President Joe Biden have been talking about taxes. Donald Trump wants to talk about lowering taxes. The current president wants to talk about raising taxes on corporations, raising the rate of a corporation that has buybacks, and also a wealth tax, a billionaire's tax, something that isn't likely to get through, but something that certainly is